Hello there, and welcome to the Kluge Wealth Advisory Group Client Monthly video for November 2025. In this month's video, we're going to be covering off a number of topics, including some housekeeping items, a monthly portfolio update, a monthly market update, as well as your frequently asked questions. So let's get right into it. As we approach the end of the year, there are a number of items I want to touch on here in our housekeeping section. The first is that if you're looking to make a charitable donation and you wish to do so in shares, please reach out to any member of the team and we can help facilitate that process for you. For those of you who don't know, if you do make a larger charitable donation of a few $1,000s, there's often a benefit in donating appreciated stock because that stock is exempt from capital gains taxation. So you get the tax receipt, you avoid the capital gains tax, and the charity gets their donation. So win, win, win. Secondly, I know we're coming up on the December quarterly installment deadline for taxes. So if you're interested in understanding where your realized gains and losses are for the year, the team and I are happy to provide you that information so you can game out what your potential tax liabilities are. And finally, I just wanted to emphasize that we are heading into the Yuletide season, and there are a number of holidays coming up that will impact processing times and our team's ability to get things done for you as we come into year end. So if there is anything that is required or that you do need done before year end, please reach out as soon as possible so that we make sure that we can get it done for you in a timely fashion and so we're not impacted by back office closures or other processing delays that can come when there's a heavy holiday season in the back offices. Now, let's move on to the rest of the call. Well, November was an eventful month overall for markets. We started the month off with a decline in major indices of between 5 and 7%. And then into month end, we rebounded to finish flat to slightly down, depending on which major index you want to look at. There were a few causes for this month's volatility that we can identify. The first is likely that markets just probably needed a break after being up for 6 straight months from April. The second is that there were fears around AI stocks and technology stocks in general that were raised. And the third is that we experienced a government shutdown. And in the absence of any data, investors began to grow nervous about the fact that the Federal Reserve may or may not lower interest rates again here in December. Now, if you take a look at what did best and what did worst over the course of the month, you can definitely see that pattern where technology stocks, as well as stocks that have done the well year to date, the momentum stocks, fared the worst, and very, very defensive stocks such as consumer staples and healthcare stocks fared the best. Now, if we take a look more broadly at commodities, we see that generally commodities were flat. However, notably oil was down, Bitcoin was down, and gold was up. And if we look at interest rates were pretty stable and maybe a little, pretty stable to being down a little bit over the course of the month. In terms of portfolios, we did see a small drawdown amongst all of our models over the course of November. Now, that drawdown is attributable to the little extra emphasis we have on innovation and large cap technology stocks in our portfolio. Despite strong earnings that were reported over the course of the month, we did see a pullback in technology shares over the course of November. Now, I know it doesn't always have to make sense, but that's what the market does sometimes. We had great earnings, but at the same time, we saw share prices decline. So, as we turn to your frequently asked questions here over the course of November, I'm going to give a quick summary at the end of this segment, and then I will go into more detail in 3 following segments. So, as we went through our client conversations here over November, there were 3 questions that emerged as the top 3. The first was around the November volatility, the second was around tax loss selling, and the third was around outlook. So the very brief summary of the answers to those questions is that November volatility was likely caused by a combination of the US government shutdown and markets just needing a break after going up for 6 months straight. The second is that we have completed what little tax loss selling we're able to do here. This is something you always want to be very careful with, and we didn't really have too many targets to start with, but that has been done. And thirdly, in terms of outlook, based on the factors that I'm looking at on my dashboard, the bottom line is that I think the outlook over the next 12 months looks really, really strong. So we're going to go into some more detail on those questions in the following segments, but that is your bottom line, too long didn't read, answer here. Thank you. In terms of frequently asked questions, we did see a lot of questions about the causes for the volatility that we saw in November. So I want to take you through a few of these potential causes. But I did also want to note here that this drawdown of between 5 and 7%, depending on which index you're looking at, was the 7th drawdown of greater than 3% that we've seen so far in 2025. So it always pays to remember that these type of drawdowns are very, very frequent and happen almost every 6 weeks. So nothing unusual from that perspective. In terms of causation, I think there's a couple of things we can look at. The first is very, very simple. Markets have gone up 6 months in a row, and they just needed to have a bit of a break and have a bit of a reset. Now, I would presume, based on the indicators that I have in front of me, that they would resume their march higher, but of course, things you never know for sure. But again, it's very likely a pause that refreshes. The second is that we did see a bit of a shift in sort of the negative narrative, and that can always catch investors off guard. We did see a shift in the negative narrative from tariffs and inflation to AI bubble. Now, we've been talking about this for some time, and I've gone into a lot of detail on my last video about why we do not believe we are in a bubble, or anywhere near one, frankly. However, that was a change in narrative, and that, of course, raised fears. And when you have fears up, investors, you do see reflexive selling. So that's definitely part of it. The third, I would say, is important and maybe a little bit overlooked, was the impact of the U.S. government shutdown. Now, in the U.S., when the government shuts down due to a budget impasse, employees don't go to work. No work is done. And there's a lot of things that the U.S. Treasury does in the background to make sure that banks have lots of reserves, that money's flowing through the system properly, et cetera. And if those pipes aren't properly attended to, you can see a temporary dip in liquidity. And I think that that's partly what caused the November pullback. And I think that's also why you saw that pullback led not only by tech stocks, but also the stocks that had done the best year to date. And people selling what they can or what they feel best about selling versus versus other options. So we always want to remember that what we're seeing here is pretty normal in terms of this frequency and size. And this also dovetails into comments around the pullback we saw in Bitcoin, which was much larger, around 30 to 35%, depending on where you want to measure the price. But it's also important to remember that Bitcoin's volatility is 4 to 6 times as high as common stocks. So if you have a 6% pullback in stocks and you see a 30% pullback in Bitcoin, those two things are roughly equivalent. So again, there's multiple of these 30% pullbacks in Bitcoin over the last year. And it would always emphasize that for clients that do own it, it's a very, very small percentage of the portfolio and has been a long time holding, so we are generally deeply insulated against this type of volatility at this point. Now, if you want to discuss this further about the impact to you personally or just questions in general, I'm always encouraged, just pick up the phone, give us a call, email us, be in touch, happy to talk about things and give you a more detailed view or just discuss the particularities in your situation. Thank you. Another frequently asked question we saw over the course of November was about the potential for any tax loss selling. The bottom line is that even with the November volatility, there really wasn't a lot of potential for that. Most of the positions we have over the last few years have done very, very well. And even ones where we might be down a little bit, the bottom line is the tax loss is not a lot compared to the future potential for the share. So more likely to be more profitable to be patient. Now, if you are considering tax loss selling for yourself inside of a self-directed account, I always want to encourage you seek outside tax advice. But the bottom line is that you always have to be aware of the superficial loss rule, which means that if you sell a share and you rebuy it within 30 days or an equivalent within 30 days, that loss will be disallowed. So you want to be careful with that and making sure that if you are taking a loss, that you switch those funds over to something that has a different exposure, so that the CRA, if they were to take a look into your transactions, doesn't have a problem with any of them there. Now, of course, as I said before, always seek your own tax advice. But if you do have any questions, here to help and happy to give you any perspective that we can. Over the course of November, we saw a lot of questions about the outlook. So I want to take a few moments here to discuss this in just a little bit more detail. So the bottom line is that irrespective of anything else, the indicators that I have in front of me indicate that we're looking at a very strong period here over the next 6, 12 to 18 months. Now, what are those indicators? The first is going to be sentiment. Now, I know I've talked about this a little bit, but the bottom line is that when investors are very fearful or uncertain about markets, that actually leads to good longer-term results. And when investors are very confident about markets, it leads to negative results. So sentiment is a contrarian indicator. And right now, investors are very, very fearful. The average level of investor sentiment is somewhat equivalent to what we saw in 2022 when we were in the middle of a bear market and a 20-odd% drawdown. So that doesn't match up. Now, given that level of fear, that tells me that based on history, the likely path for the markets is going to be sharply higher here as we go forward. If we take a look at technical and quantitative trends, those are all intact, and all the quantitative data points that I'm seeing come out from data studies are positive here over the next 6 to 12 months. The other thing that's very important for markets is liquidity. Now, we know we suffered a bit of a bump in the road with liquidity with the US federal government shutdown. However, we are looking at a Fed rate cut coming up, as well as several other regulatory changes in the US that should enhance liquidity. And as a quick reminder, liquidity is essentially the oxygen in the room for the market and the economy. So what we're going to see here is that the amount of oxygen is going to go up. And historically, that's not only been good for the economy, but it's been very, very good for stocks. Now, speaking of the economy and corporate outlook here, the bottom line is that the recent earnings season and guidance was very, very strong. We saw profit margins go up, which is extremely positive, and we saw earnings beat expectations by a very wide margin. So I think that's another positive signal. And then finally, even with a housing market that's in a very, very difficult spot right now in the US, we're still seeing real-time indicators of gross domestic product growth, or GDP growth, telling us that rate has now accelerated up to around 4% for the fourth quarter. So if next year we were to see a revival of the US housing market, we could easily see that number or something much larger. So the bottom line is that we take a look at everything from the economy to the way corporates are behaving, to liquidity, to sentiment, as well as to studies of charts, data, charts, flows, etc. All of these indicators are pointing up. Now, this doesn't guarantee anything. However, historically, this has been a very, very strong indicator that strong markets are ahead. And so based on that, I've got to be positive. Now, if you'd like to dive into this in a little more detail, or you'd like to discuss something else that's on your mind in regards to the outlook, please let me know. Here to help. Just be in touch. So wrapping up the Kluge Wealth Advisory Group Client Monthly video for November, we touched on a number of things here. We had a wrap up on some housekeeping items, especially pertaining to year end. We had a market update. We had a portfolio update, and we tackled a number of your frequently asked questions around tax loss selling, market outlook, as well as causes for the volatility we saw in November. Now, again, if you have any questions or there's anything that is in your financial life that you want to discuss in more detail, please reach out, give us a call. We are here to help. Thank you very much.